Good, excellent.
Okay. Well, great. We are here for our today's one of today's main events from Craig Phillips and a discussion on fintech and the Treasury Department's perspective on fintech. And I'm sure many of you have already been reading very closely developments coming out of the Treasury Department. But I am not going to be delivering. You've seen me way too much for today, I think, already. Instead, I wanted to have my colleague and my friend Arthur Long give the introduction for today's keynote speaker. Gibson Dunn is a friend of the university, employer of many of our students, and Arthur is an expert and one of the thought leaders on financial regulation coming from Gibson Dunn, and we're just pleased that he can make it from New York. So you can go on.
Thank you, Chris. Good afternoon to you all. We at Gibson Dunn are very pleased to sponsor the first annual FinTech Week at Georgetown Law School. The last few years have seen the rapid development of new technologies with great potential to revolutionize large segments of the financial industry. For lawyers practicing in this field, it is an exciting time. The growth of FinTech raises issues in many areas. Thanks to it, I can turn to my colleagues in a slew of our practice areas: intellectual property, anti-money laundering and sanctions compliance, antitrust, cybersecurity and data privacy, and our legislative and public policy practice. So it is more than timely that a leading law school has put together such an impressive symposium. New financial technologies, of course, don't just raise issues for lawyers. They must interact with, and at times challenge, the agendas of policymakers. And we have seen this in the last 6 months with certain of the policy issues taking place right here in Washington, D.C. On that note, it is a great pleasure to introduce Craig Phillips, Counselor to Treasury Secretary Mnuchin. Mr. Phillips brings a 40-year private sector career culminating in some of the highest levels of American finance to his role at Treasury. Most recently, he was a managing director and member of the Global Operating Committee at BlackRock, where he led a broad-based practice advising central banks, banking organizations, and multilateral organizations around the world. We've already seen in a few short months the results of his experience and energy. Treasury's impressive, detailed reports analyzing the effects of financial regulation on the U.S. banking industry and the capital and derivatives markets. There's a great deal of insight in these reports on the calibration of current regulation and its effects on the overall economy, on the availability of credit, and on job creation. It's just the kind of insight needed given the uncertainties in the global economy and the challenges to increasing the rate of U.S. economic growth. And FinTech, of course, plays a very significant role in all of this, disrupting financial services, processes, and markets that have been in place for decades. So there is really no one better suited to give this keynote address than Craig Phillips. Please join me in welcoming him.
Good. Well, thank you very much. It's an honor to be here to address the first annual FinTech Week conference here, and we appreciate Georgetown to host it. I guess it's only appropriate to be introduced by a lawyer at a law school. So, Arthur, thank you very much for your kind introduction. And really, on behalf of the Secretary and the entire Treasury, we really appreciate this opportunity to have a discussion. You know, the nature of being able to talk to groups and socialize our ideas, and I guess I have an announcement about some new work we're going to be doing in this space. It's great to be able to connect, and quite a number of my colleagues will be here over the next 3 days. It's really fitting that we're at a university campus, a place dedicated to learning, because what we really want to put forward here is the need for policymakers and the business community to do exactly that, to learn. So the rapid pace at which fintech companies have sprung up in the past several years is impressive, and each are very eager to take on and address a very wide range of market opportunities. Since 2010, for example, global investment has nearly tripled, while global VC funding in such firms is up nearly 13 times in the same period. So in the light of this exponential growth of financial technology, policymakers must react to understand the immediate benefits to customers, but also the implications for longer-term impact on economic growth and financial stability. The conference, I know, has a lot of impressive speakers and participants, so I really am hopeful that it'll be a great exchange. I really look forward to seeing the readout from the sessions. And I would say that I think you're focused on exactly the right issues, things such as the intersection of crowdfunding and sort of raising capitals, as commented in our recent report on the Jobs Act, distributed ledgers and the future of payments, cyber risk, and risk management and regulatory reporting, to name just a few. So today I'm going to really frame my remarks through the lens of the core principles that the President has put forward for the financial system. But first of all, I want to take a moment to really talk about innovation. And really, financial technology is really at the heart of that concept, innovation applied to financial services. So innovation embodies the spirit of the American economy. We've grown to expect innovative solutions to even the most mundane questions, to be the people who dream up things that haven't happened yet and make them happen. Many often envision innovations as being startups, or some startups gamble. But according to the Federal Reserve Bank of New York's survey on credit, startup firms account for about 1/3 of small employers, but really play an outsized role in innovation and also are the largest contributors to new job creation. So in our quest to have better economic growth, encouraging small firms in general, whether fintech or not, there's a very important priority here that we're addressing in our policies. When we think about the range of participants and issues, it isn't just startups. You might have large financial institutions with in-house innovation initiatives or incubators. You might have startups with just a few founders with pivotal payments technology. There might be partnerships between smaller firms and larger firms to create a nimbleness and an innovation. And lastly, many large non-bank technology giants are increasingly providing financial infrastructure. So this is a very wide potential combination of small companies and large companies working together independently, and we need to think of it from that framework. So in addition to significant and growing investment in fintech companies, the market valuations of public fintech companies have quadrupled since the financial crisis, and general interest in this has grown exponentially. Obviously, with such high returns and investment, this in turn draws additional investment. So I think we can say it's an area that's very well funded and therefore is likely to continue to grow at a very rapid pace. Opportunities to innovate can and have incentivized entities to work together to bring to life financial technologies that hope will increase productivity. This kind of cooperative activity improves the likelihood of a successful solution and benefits the overall economy. According to a World Economic Forum survey, a majority of experts and executives in the information communication technology sector believe at least 10% of global GDP to be stored on blockchain platforms by 2025. Many of the largest banks are seeking partnerships with smaller, lean startups, which can then, in fact, be disruptors to their traditional delivery system. So through all this innovation and the robustness and soundness of the financial system must be sort of maintained. And with that, I'll come back to really the core principles and kind of how we might see the regulatory environment squaring up with the great opportunity of innovation I've talked about, but also the responsibility to regulate the system. So President Trump issued Executive Order 13772 on February 3rd and directed the Treasury Secretary to identify statutes, regulations, and other guidance that inhibits the regulation of the financial system according to the core principles. So those core principles are really basic values and are fairly enduring. I think there'd be very little disagreement with them. Empowering Americans to make independent financial decisions and informed choices, preventing taxpayer-funded bailouts, fostering economic growth through financial markets, enabling financial service companies to be competitive with foreign firms, advancing American interests in international financial standard-setting bodies, making regulation efficient, effective, and appropriately tailored, and restoring public accountability within the regulatory agencies and rationalizing the financial regulatory framework. So one might reasonably interpret that this last principle does include appropriately tailoring regulation in cases where a clear financial regulatory framework has yet to be established, which I think we can all agree is the case with the fintech sector. So our first 4 reports are really responsive to these topics. Our first was released on the banking sector in June. Second was released in early October, covering capital markets. And in the next couple days, we'll release our third on the asset management and insurance industry. But I'm pleased to announce that we will be working on a fourth, which we hope will have input from this group and others like you, which will cover non-bank financials, fintech, and specifically innovation. So if you look at our prior reports, it'll give a sense of the type of scope we're trying to cover. And one initiative we have here is to make sure everyone knows we're working on this and that we really, really appreciate input. So these core principles really speak to traditional financial services, and I'd like to address just a few concepts that you might say tie into fintech the way we're thinking about the exercise. The first is fostering economic growth and enabling financial service companies to be competitive. So really, if you take marketplace lending, it now makes up over 24% of all personal loans, roughly $18 billion worth of loans, nearly tripling between 2014 and 2015. Treasury believes that innovations that enable access to financial information, decision-making tools, and products are very, very important. Specifically, we're interested in studying how advancements in financial technology are changing the way that consumers and small businesses can get access to credit. And online marketplace lending is clearly one of these advancements that has tremendous potential. In our previous reports, we've also outlined areas of a financial regulatory framework that aren't effective or properly tailored for existing competitors. And we focused a lot of attention on the need for harmonization among regulators, reducing fragmentation and redundancy. So as we think of a framework for the financial technology sector as technology evolves, we will definitely keep these same principles in mind. Innovations in financial technology has impressive potential to lower the cost of transactions and also lower the operating costs of small and large businesses. According to Accenture, applying blockchain technology to many middle and back office processes such as clearance and settlement and streamlined centralized financial reporting could reduce investment banks' infrastructure costs by 30%, which would be a savings from $8 to $12 billion per annum. Since the financial crisis, these large institutions have struggled to have a market return on capital, so savings like that would be at a tremendous premium and very valuable to the marketplace. A second category is empowering independent financial decisions. A great example of this in fintechs is the area of robo-advisors, where while asset under management are still very small, they've increased by over 8 times in the last 5 years, according to Deutsche Bank researchers. Robo-advisors and personal financial wealth advisors provide, like other financial tech innovations, financial service digitally and have the potential to do so under a very low cost structure compared to traditional providers. So these low marginal costs in turn can make it economic to serve a larger pool of clients and empower investors to make more informed choices about their savings and their finances. Marketplace lending also can power lending, but also expand access to credit. In our banking report, we talked a lot about the banking system and how it covers rural and underserved areas. A recent study by economists at the Philadelphia Fed provide evidence that these types of new lenders may well be filling in gaps in access to credit that aren't addressed well by the traditional branch banking system. A third area is making regulation more effective and efficient. So new technologies can be employed to improve compliance and regulatory regime, I guess an area you'd call RegTech. Sophisticated data analysts and software, for instance, can help monitor transactions to really help compliance with anti-money laundering or counter-terrorist financing regulations, both of which are huge functions within the treasuries and are aligned with the president's agenda in national security and something my boss spends a lot of time on every day. But automated and upgraded technology can allow for less painful regulatory reporting and benefit firms as well as the supervisors that are trying to assist them in the support of these law enforcement activities. There's a myriad of other RegTech efforts underway. These technology solutions have to be proven reliable and consistent, but hopefully will catalyze change ultimately in the regulatory process. I see some of my friends from the CFTC today. Chairman Giancarlo has launched the Keep It Simple, Stupid initiative, or the KISS initiative. And, this is really very logical as you think about regulation that, if you can improve the technology and analytics you're using, you have to have the rules catch up such that those improvements can be absorbed and used by the market. So these are just a few of the areas that I wanted to touch on. There are many, many more that I could cite. So really, as I mentioned in terms of learning, there's immense potential to grow. There's things we don't understand about this yet. It's important that regulators roll up their sleeves and engage directly with innovators to begin to understand the implications of this fintech and sort of how to contribute to this innovation without stifling it. So I know during the course of the session, there's several regulators that you'll be interacting with. I spoke to Keith Noreika today, the controller of currency, and really compared notes with he, and I think you'll find that he too has a vision of, there's innovation. We need to find a framework to introduce that and to reward it. So hopefully during the course of this, I know many of you are from outside Washington, you'll get a sense of where the leaders here are thinking. So today I'd kind of close by really thinking about three areas of questions that are in our mind, and as we start to do the work on our fourth report, we'll be thinking. The first is, how would a given development in fintech fundamentally alter or impact a market structure or core process in today's system? So something that truly does alter the way business is processed. More financing is coming from non-traditional lenders, including startups and fintech's originators, and it's worth considering the implications of providing lending credit as well as servicing these loans through this fundamentally different relationship and delivery system. As we set forth a policy for safe and sound financial system, we have to ask how different will these market participants behave, and what will the experience be for the borrowers, and how might changes manifest themselves at different points in the economic cycle in terms of the reliability of this credit to be supplied. If we become dependent on these flows of credit during good times and then they suddenly stop, this type of disruption could disrupt credit if traditional lenders are squeezed out. So you really have to look at this not just in this boom cycle, but sort of a through-the-cycle analysis. The second question is, how does a fintech's relationship with traditional financial institutions, such as banks or even non-banks, change the appropriate regulatory framework? In the last administration, the Treasury put out a report that really talked about the relationship of fintech and the banking system, and it showed there was a lot of interrelation between non-banks and banks in this space in processing and doing bank-like activities that do require a charter. So today, many firms do partner with banks and other enterprises that are regulated, and the regulatory requirements that would sort of govern the safety and soundness really have to be rethought to contemplate the nature of that arrangement, both to allow emerging banks to perhaps be regulated, but also the nature of the risk associated with the interrelation between fintech companies and the banking sector. And the third question is, how does a given fintech impact or materially change the infrastructure of a given financial institution or the financial system itself? So sometimes we default to the assumption that faster is always better, and kind of all the apps you buy, this is generally the case. You're kind of doing something in a way that you consider faster and better. But speed and efficiency has to be really achieved in concert with the safety and soundness considerations when you deal with financial considerations, and particularly the nature of cyber risk. So there are risks to our financial systems that we see every day. These could become taxpayer risks in the extreme. Cyber attacks aren't more susceptible, or fintechs aren't more susceptible to cyber attack, but it does raise the question about the infrastructure associated with the industry and the implication of the non-banks that are entering. So I guess as an overview, I don't have any big announcement about a regulatory approach other than the fact that we're going to do this review, and out of that we'll hopefully create ideas that will be a framework for regulators. People don't have to do things that are in our report, but it's a framework, and in addition to interacting with a large amount of stakeholders, we do interact with all our regulatory partners to think this through, as we've been doing at our FIBIC committee on cyber risk as a whole, of which the Equifax matter has sort of elevated our attention even further. So really, in order to maintain the strength of our economy, we need to constantly evaluate the regulatory system and consider how it will evolve to support our markets and facilitate investment and growth in the economy, while looking for a level playing field in the U.S. and abroad. I see a couple of colleagues from Europe. Obviously the whole perspective of how Europe's approaching this fintech regulation is something we're also very mindful of and in discussions. So some financial agencies have taken some initiatives. The OCC, for instance, has launched its Responsible Innovation Framework, which Keith Noreika is going to talk about. And the special purchase charter for fintech companies has emerged as one element of the OCC's approach, among many others. In developing a framework for the charters, you have to consider sort of bringing new institutions under a regulatory umbrella, and sort of looking at a holistic approach to evaluating the implications to the financial system. As policymakers, we have to determine through what channel it makes sense to bring institutions into the framework, and to do so with the whole notion of both federal and state regulation in mind. You know, we have a federal regulatory framework that's memorialized in banking. As these companies are introduced, not in the context of that federal charter, you also have very important state regulatory considerations that have to be woven together. So we have a fairly complicated path ahead of us. I think, as evidenced by the diversity of speakers and the international factors I mentioned, hopefully you'll see movement towards an understanding of the complexity of the business models that are being discussed, and the growing importance of fintech. So we can't really do this in a vacuum. We really do look forward to engagement. Our process to do these executive reports have been extensive outreach. So this outreach has been with bilateral meetings, groups, trade groups, you know, meetings such as this, academics, consumer advocates, and many others we intend to really engage with. Jessica Raniere, who's here today, is spearheading this project with several others at the Treasury. And so if you just watch for announcements about what we're doing, we really do appreciate input. It's a bit of a diverse community to figure out how to connect with it, so we welcome the chance to speak today to make sure everyone was aware of what we're doing. Coming back where I started, we really want to learn for each of these reports. This outreach has been invaluable. I'd say the span of what we're doing in this report is very immense, because we're going from non-banks, which range from storefront credit operations to fintech to rather sophisticated evolutions in payments and other systems, in the extreme cryptocurrencies and beyond. So this is a really wide space. But what we found from doing our work in the regulatory system was a very large amount of business was leaving the regulated system due to the burden of regulation. So we applaud that. You know, we look at it as a positive trend, but we also look at it as a slice of the financial economy that we have to be mindful of. And so we're very, very excited about this to unfold. It'll probably unfold over the fall with a report that'll come out sometime or early in the next year. So first of all, I want to again thank you for having us here today. Our colleagues will be here for the next several days, so you'll probably have an opportunity to interact with some folks in the Treasury. And I want to again thank you for your time. If there's a couple questions, I'm glad to, if there's anything on people's mind, I'm glad to answer a couple questions if anyone has any.
Identify yourself for us.
Isabel Oakland with Inside U.S. Trade. Regarding Treasury's semi-annual foreign exchange report to Congress that was released yesterday, the department again did not name any currency manipulators. And in this sense, have you seen a real improvement in China's, in particular China's currency disciplines? And then I have a second trade-related question. Regarding NAFTA, how does the Treasury Department plan on working with USTR as the NAFTA talk proceed, given the demands by certain industry groups to include currency provisions in the new deal?
Well, I'm going to answer really boldly by telling you you've got the wrong guy to answer those questions. So I will comment just briefly. I'm not involved in NAFTA or trade, so I'm not being evasive, but it really isn't in my portfolio. I will say the currency report is issued consistently every 6 months. There's an incredibly rigorous process that's done consistently through the cycle, and if you read it, there are the criteria for each country, and I believe there's 3 criteria to meet. Some meet 1 criteria, some meet 2. That's changed through the cycle, so it is a consistent process that we apply. We look at it very carefully each period, and so I think the results in the report are explained pretty clearly. But again, it's so I can't be more responsive on either because it's not in my portfolio.
Fabrice Coles, Congressional Black Caucus. Thank you for being here. Very excited to hear about this new report. We care very deeply about financial inclusion. We think there's a lot of opportunity for the financial inclusion to help with technology to really drive the ball forward. Will Treasury be working with the CDFI community to facilitate some of these explorations about how to leverage the work that the CDFIs are doing, marry that with technology?
Well, sure. I spent a lot of time with Annie Donovan and the CDFI team, and spoke at their very large conference here in New York recently. And I think that, you know, the problem with inclusion is that the banking system, in some ways, as big as it is sort of shrinking its footprint, you know. And so, in the nature, there's almost no de novo banks, and you know, and we've addressed that in our report. And there's a larger and larger concentration of the largest banks, and clearly a branch of a really large mega bank behaves differently than a community bank, how it faces the community. So I would be hopeful that this initiative of financial services would be related to inclusion and access, you know, as you get away from the traditional bank footprints and the delivery system. We're in the process of doing a review of the Community Reinvestment Act, for instance, following our first report, to really try to understand how banks can better invest in the community. And that's a perfect example. If you have a fintech charter in a bank and they have no branches, how do you even measure assessment area? And we already have banks that have a very large amount of their footprint raised basically through the internet, such that even measuring the traditional responsibilities under community reinvestment are no longer applicable. So we're doing a pretty big study of that, and I think it's also related to your question. As to CDFI, I think everything has to modernize, so hopefully, you know, I've met with a lot of those institutions that are in the program, and they struggle like any other community bank with too much regulation and too much burden. I think technology can help that, and hopefully there's as much innovation in that area as there is, you know, across the board, and I'm hopeful that it'll help inclusion. There's a sign that access to credit and other services can be achieved through technology. Well, you know, I say we're at the beginning of the study, not the end of the study, so I think exactly what will come out of this will be an answer to those questions. And I think we plan to work with all the regulatory agencies to think about harmonization. So rather than having every regulator go at this from a different angle, try to look at this as a sort of a new and exciting trend, and trying to help existing banks be able to innovate more, not just see the innovation outside the banking system, but if there's financial services being delivered, and there's now a merger of these services where people have bank-like services and seek charters, that what our report will show will be a framework of how we should think about it. So I don't have an answer other than to say that the whole report will be specifically focused on having an answer when we deliver it, and really trying to work with all the regulators to make sure it's a harmonized answer. I think this is very fragmented now. There is not a uniform approach. There is now real scale. When you mention something like Amazon, if they entered something like financial services, they could obviously be enormous. So I think there's great potential in that, but it obviously raises, where does banking begin and end, and how do we think about regulation? So I would be hopeful that our report will answer exactly those questions, and that's why it has to be undertaken.
Well, yeah. we appreciate those questions and making yourself available.
Good. Thank you very much. Yeah.
Thank you so much. Okay, we have drinks. After a long day of talking about finance and technology, nothing does the soul better. So I think we're in the back, in the very, very back of the room. Thank you so much for showing up. Tomorrow we have an outstanding conference. We'll also have the Comptroller of the Currency. We'll have Brian Quintens, Kara Stein from the SEC and the CFTC, as well as conversations on distributed ledger technologies, cryptocurrency panels headed by former CFTC Chairman Jim Newsom. We're having a full, very, very full second day, and so I look forward to seeing you all tomorrow as well. Thank you.